How panic spreads, the science of financial fear. It never begins with screaming. It begins with silence, a hesitation, a rumour. A single moment when trust slips, just slightly. History shows that when confidence cracks, fear doesn't stay contained. It moves, it spreads, and once it starts, it rarely asks permission. How panic spreads, the science of financial fear. It never begins with chaos. There are no alarms at first, no warnings on the screen. It begins quietly, with hesitation, with a rumour that sounds harmless, with one institution pausing just long enough for others to notice. Confidence is the invisible foundation of every financial system. You cannot see it. You cannot measure it precisely. But everything depends on it. When that confidence weakens, people do not panic all at once. They watch each other, they wait, they listen for signals that something is wrong. And then comes the shift. Questions replace assumptions. Doubt replaces routine. Normal behaviour starts to feel dangerous. History shows this moment again and again. Not when fear explodes, but when trust quietly slips away. Because once confidence breaks, fear does not stay isolated. It moves through markets, institutions, and people. Fast, relentless, and often unstoppable. A historical hook when fear broke Wall Street. In October 1907, the American financial system didn't collapse all at once. It hesitated. A single trust company came under suspicion. No confirmed losses, no formal failure, just uncertainty. That was enough. By morning, people lined up outside banks across New York, not because they needed cash, because they saw others asking for it. Within hours, trust companies were bleeding deposits. By days, banks stopped lending to one another. Money still existed, but it stopped moving. There was no central bank to step in, no emergency playbook, so fear filled the vacuum. Perfectly sound institutions were treated as guilty simply for being questioned. Rumours moved faster than ledgers, and hesitation became a death sentence. At the centre of the chaos was J.P. Morgan, who gathered the most powerful bankers in the country inside his private library. Doors locked, decisions forced. Who would be saved? Who would be allowed to fail? Nothing essential had vanished overnight. Factories still worked, workers still showed up, assets were still there. But confidence was gone, and once confidence disappears, fear doesn't argue. It spreads. Quietly at first, then everywhere at once. What is financial panic? Financial panic is often described as irrational. That word misses the point. Panic is not the absence of logic. It is the presence of fear under uncertainty. In calm periods, financial systems run on trust. Depositors trust banks to return their money. Banks trust other banks to lend overnight. Investors trust that prices roughly reflect reality. Panic begins when that trust weakens. No balance sheet has to collapse. No asset has to hit zero. All that's required is doubt and the belief that someone else might act first. Once that belief takes hold, behaviour changes. People stop asking, "Is this institution safe?" They start asking, "Will everyone else think it's safe tomorrow?" That shift is everything. Withdrawals that make sense individually become destructive collectively. Selling that feels prudent in isolation becomes catastrophic in crowds. This is how fear turns movement into momentum. Each action confirms the next. Each exit encourages another. Financial panic is not a single decision. It is a chain reaction, a social event disguised as an economic one. And once it starts, the system no longer responds to fundamentals. It responds to fear itself. How panic spreads. Like a virus, panic does not move randomly. It follows paths. Financial systems are networks. Banks linked to banks, funds tied to funds, households connected through shared information and shared fear. When stress hits one node, the reaction rarely stays contained. At first, the damage looks isolated. One institution, one market, one headline. But networks amplify behaviour. When one bank pulls back lending, others notice. They respond by pulling back too, not because they are insolvent, but because they don't want to be last. Liquidity disappears not from lack of money, but from lack of trust. This creates feedback loops. Falling prices force sales. Sales push prices lower. Lower prices signal danger. And danger triggers more selling. Like a virus, panic spreads through contact, a rumour shared, a chart posted, a withdrawal line photographed. Each transmission carries emotion, not analysis. Once fear reaches critical mass, the system shifts phases. Normal safeguards stop working, diversification fails, correlation goes to 1. At that point, stability itself becomes fragile. What makes financial panic so dangerous is not the initial shock, it's the speed at which reaction overtakes reflection. By the time policymakers recognise the scale of the problem, fear has already moved ahead of them, embedded in decisions, locked into prices, and reinforced by the simple fact that everyone can see everyone else running at the same time. The role of news, rumours, and social signals. Panic needs a carrier. In modern markets, that carrier is information. News does not just report fear, it organises it. Headlines compress complex situations into moments of urgency. Breaking news replaces context. Speed replaces reflection. In periods of stress, people don't read deeply. They scan. They react. A single rumour, repeated enough times, starts to feel like confirmation. Unverified claims gain weight through visibility alone. The more something is seen, the more real it feels. Social signals matter just as much as facts. A falling stock price is not just a number, it's a message. A bank-run photo is not just documentation, it's a warning. Digital networks remove friction. Fear that once travelled city to city now moves globally, in seconds. There is no pause for digestion, no buffer for perspective. And the most dangerous part is this. People know they're being influenced but act anyway. Because when everyone sees the same headlines at the same time, individual restraint feels reckless. Waiting feels irresponsible. So reaction becomes synchronized. Selling clusters. Withdrawals accelerate. Information stops being neutral. It becomes fuel. And in moments of financial stress, the loudest signals are rarely the most accurate, but they are the ones that shape behaviour first. From individual stress to systemic breakdown. At the start, panic feels personal. One household, one investor, one decision to be safe. But financial systems don't experience fear as individuals. They experience it in aggregate. When enough people act on the same fear, institutions are forced to respond. Banks raise cash, funds sell assets, lenders pull back. Each action is rational on its own. Together, they become destructive. Liquidity begins to vanish, not because money is gone, but because no one wants to part with it. Markets that depend on constant trust suddenly seize. Assets are sold not at fair value, but at whatever price clears. Losses appear where none existed before. Balance sheets weaken in real time. This is the moment where panic turns structural. Fire sales spread stress from one institution to the next. Collateral values fall. Margin calls rise. What started as fear becomes mechanical failure. The system enters survival mode. Rules designed for stability amplify instability. Risk limits force selling. Accounting standards lock in losses. Precaution becomes punishment. And then comes the sudden part. Credit freezes. Payments delay. Ordinary people feel it, not as charts, but as closed credit lines, frozen savings, lost jobs. The collapse never looks dramatic at first. It looks like friction, like delay, like temporarily unavailable. By the time panic is visible everywhere, The damage is already embedded, not in markets, but in daily life. Why this matters today, modern financial systems look stronger than the past. More data, more oversight, more safeguards. But strength and stability are not the same thing. Today's markets move faster than ever. Information is instant. Reactions are synchronized. Confidence can evaporate globally before institutions have time to respond. The architecture of finance has changed, but the psychology has not. Debt is still built on trust. Liquidity still depends on belief. And fear still spreads socially, not logically. The tools designed to stabilise markets can mask fragility. Artificial calm can delay adjustment, and delayed adjustment often makes the final break sharper. Small shocks matter more in tightly connected systems. A single failure can echo through markets that appear diversified but move together under stress. What history shows is not inevitability, but vulnerability. Panic does not require a massive trigger. It requires alignment, enough people seeing the same signals at the same time. That is why periods of apparent calm deserve the most attention. Because panic does not announce itself as danger. It announces itself as hesitation. And by the time fear becomes obvious, the system is no longer choosing. It is reacting. The pattern hasn't disappeared. It has only accelerated. How panic spreads. The science of financial fear. If you want to know more about behavioural finance and panic psychology, stay tuned and don't forget to subscribe. Panic is never random. It follows human instinct, it follows networks, it follows history. It begins quietly, spreads socially, and accelerates mechanically. Not because people are foolish, but because they are human. Every financial system is built on confidence it cannot see and trust it cannot enforce. And when that trust slips, even briefly, fear rushes in to replace it. The pattern is old. The speed is new.